Good morning and welcome to the next webinar in our series. Hey, today we've got a really exciting one, and we've actually topped out the amount of registrations that we can have. So if you get into this call, you're really lucky. I'm just going to bring my guests up on stage and then we'll get started, and then I might just adjust my blind as well, because in Dunedin here today, it is a beautiful day. There's Dan. I'll just bring him up on stage. And then I'll just grab Thomas. Lots of you to look through to find him. Is Thomas. There's Thomas as well. So we'll just wait for my guests to get up on stage and then we'll get cracking and get underway. Thomas and Dan, pop a note in the channel on the right-hand side if you cannot gain access. We'll see how we go. That's somebody coming. Good morning. How are you?
Hello.
Brilliant.
I'm good. Not as sunny in Auckland as it is in
It's
Dunedin.
an absolute cracker today. Hey, look, I'm just going to try Thomas again. Thomas, invited you up. Let's see if we can get you. Always a wee bit of a technical snafu while we're getting started. There he goes. Woohoo! Okay. We'll just wait for him to jump up on screen. Good morning, Thomas.
Good morning.
Good.
Hello.
Right, we can all see and hear each other, and that's brilliant. So let's get underway. So today, I was just saying that we've got an amazing audience here today. We've actually had the most registrations we've had in any of our webinar series, which is a little bit of a big feat because we've had some incredible guests on over the last couple of years. Now today we're going to be talking about unlocking property potential, mastering the art of property development. And today I'm joined by my guest Thomas Ward, founder of I Am Developer, a development consultancy aimed squarely at helping you unlock the potential of any site with specialties in development strategy, acquisitions, feasibilities, design and consenting, and finance analysis and assistance. Thanks for joining us today, Thomas. You're welcome. Also joined today by Dan Bell, property manager at Squirrel Mortgage Advisors, who make the process of financing property transactions super easy. Hi, Dan. Thank you for joining us today. You're welcome. Let's just jump straight in. We've got a ton of questions to get through today, but we're going to have a pretty fluid sort of a conversation, which is really cool. And so we might go off topic a little bit. If you've got any questions, pop them in the audio cutout, but refreshing the page. Okay. Yep. Sometimes if you go out and back in again, Daniel, you can remedy that problem. Pop questions in the channel on the right hand side and we'll get to them at the end. We're aiming to go for about 30 minutes and then we'll have 5 or so minutes of questions. Got tons to get through, so let's get started. First off, let's jump straight in. What are the steps involved in the property development process from start to finish, and what are some of the main considerations? Thomas, I'll hand over to you, but Dan, please feel free to jump in.
Sure. So I guess with most development projects, there can be quite a variation in what you're trying to achieve. But at a high level, they generally all follow the same key steps, whether you're doing a single lot subdivision or a townhouse development. And when we're running through with our clients, we like to try and keep things really simple. So at a very high level, we break it down into sort of 3 main stages. So stage 1 is what we call the incubation period. This is when essentially we are doing as much information and data gathering as we can. We want to essentially test different hypotheses, and we do this through the feasibility stage. That then rolls into the design stages, and we finish our stage 1 with the resource consent. So that's what we call the incubation stage. Stage 2 is essentially what we call getting build ready. And so that stage is then we then jump into construction documentation. So that's usually a building consent. If we're doing subdivisions, that involves a stage called EPA, or engineering plan approval, which is about doing the design for all the underground services. And we also tick off any other boxes required. It might be vehicle crossings, works over approvals, all those sorts of things, everything that we need to get build ready. And also by the end of that stage 2, a big key one, which Dan will talk a bit more about, is having your finance ready. Because then our last stage, stage 3, is essentially let's get building. And so that involves all the on-site works, whether that's works for subdivisions, which are underground services, driveways, those sorts of things, but also the constructions of the dwellings. So yeah, at a very high level, as I say, we try and keep it really simple. 3 stages. Stage 1 is the incubation period, which is about testing ideas, doing the design, finishing up with the resource consent, which is the tick of approval from the council. Stage 2 is then about getting everything else in place that we need to start building. And stage 3 is about building and
are there
the
any
project.
considerations to be taken into account at any of those particular stages, Thomas?
I mean, I guess there's lots of different things. I mean, the stage 1 is about setting a really good foundation for the project. And that's why we always emphasize the importance of the feasibility stage, because that's, at the point where you've spent the least amount of money and you can really test different ideas to look at what different outcomes you might achieve. It is really important in that stage 1 to get really clear on what your objectives are for the project. One of the key things we always tell people is, set your objectives early and try not to deviate too much from the plan. So that's definitely one of the key considerations for stage 1 is spend a bit of time working through the feasibility and testing different ideas. And it's also, it's the point where you should be talking to as many people as possible, asking questions, talking to consultants, even, having early discussions around finance, because it's sort of the part where you're least invested financially. So you can sort of test a bit more. The further you get in, obviously you start spending more and more money, the more you want to be really sort of focused on achieving those outcomes to be able to get through the rest of it as quickly as possible.
Brilliant. Did you have anything to add there, Dan?
Yeah, I was going to say that that feasibility stage is really, really important, because ultimately, if you're developing property, you're developing a product that you're either going to sell or you're going to rent out. So you really need to understand what your objective is, what type of product and type of market you're targeting. And I think some people might be looking, in the market and seeing what's selling and what's not, and trying to get a feel for it. But actually having a real clear strategy in terms of what you're trying to achieve, checking in with real estate agents or valuers just to understand what's actually working in the particular market that you're targeting. Because there's no point, trying to build something that someone's not going to buy, or the numbers aren't going to work if you plan to rent it out. So being very clear about what you're actually trying to achieve up front.
Yeah, I mean, that rolls in as part of, what are your objectives? And once we understand your objectives, then we can work out the best strategy for you to use. Because as I say, there can be a lot of different ways that people look to develop. They might want to develop and sell for capital, put something on the market. They might want to develop and hold for cash flow. They might just be, we've got some clients who are just doing a single lot subdivision and want to build a family home at the back, keep the front for a rental. You also might be wanting to do something around social housing and working with a community housing provider. So all of these are definitely, valid strategies, but they all have their own sort of nuances to them. So getting really clear on that up front during that feasibility stage is a really good way to start the project.
And I guess there's a few things that you can do, like you were saying, before you start spending money, because you might have a site in mind, or you might already own a site, and actually doing as much due diligence as possible before you start getting into actually, getting some plans drawn up or going through a resource consent process. So really checking in to understand, what you're trying to achieve longer term, and getting as much kind of, I guess, free kind of advice and information along the way before you actually start spending
absolutely.
money.
Hey, what factors should people take into account when determining the potential of any site? And are there any specific assessments or professional services that can help them with this, evaluating this potential?
Yeah, sure. So again, the potential of a site can differ from person to person depending on, again, what your objectives are. Because if you are wanting to build and sell, you'll be looking for a site that has things like easy access, is flat, rectangle, all those little things that are going to make it as easy and as streamlined as possible. If you are building to have a family home, then things like a slightly more sloping site with views, might be something that you'll look for. So there is different ways that people look at different sites to determine their potential. In terms of how you assess that, I mean, there's a whole bunch of things that we look for. Obviously, the first one, the underlying one, is always what is my zone. That's the first way to understand what are the rules associated with this site. And actually one of the best ways to get this information as quickly as possible is actually call your local council. I find that actually usually pretty helpful. If you ask specifically for the planning help desk, tell them what your site address is and say, hey, I want to know all the development controls that are impacting my site. They should then give you a whole list that you can write down so you know exactly what's relevant to your site in particular. Obviously, there's a number of other things such as location, the location of the site. Depending on if you're wanting to build and sell or build and hold, you're looking at buyers versus renters. What's the current market there? Is there an oversaturation of development projects that are happening? There's definitely some suburbs in Auckland at the moment where it feels like there's an oversaturation of, say, terraced housing in that market. And given that the market's turned, you don't necessarily want to be a developer who's holding on to that sort of stock at the moment and you can't sell it. Carrying on through, other things we look for is the physical makeup of the site, the contours, is it sloping? What's the shape of the site? Are there any sort of narrow angles where it tapers in that I'm not actually going to be able to build on? What's the orientation of the site? Is it on the south side of the road or the north side of the road? Or my outdoor living space is going to be north facing? Location of underground services is obviously a really key one. You ideally want to have especially stormwater and wastewater public lines within the boundaries of your site. Are there any other overlays or designations impacting your site? Floodplains, overland flow paths has obviously become a big one in Auckland at the moment, and the council are now currently reassessing how they're going to deal with those. Up until those floods, it was usually understood that if you, say, get a flood report and you do things in a certain way that you can build on floodplains, but the council are now sort of reviewing that process, and I'm saying there's going to be quite a big change there. So if you're looking to purchase a site, I'd currently stay away from sites that are covered in floodplains. Obviously, access is a big one. Driveway widths. You need to have a certain width to be able to get a car down. The general rule is about 3 meters. At least 3 meters is required. Other things we look for, say, road boundary. A lot of people don't understand that, say, if you want to have a second vehicle crossing, you need to have at least 25 meters of road boundary length to be able to get that second crossing in. So that's why corner sites are good, because they usually have one short boundary, one long boundary. Means you can get additional vehicle crossings in. Other things like proximity to road intersections, street trees, power poles, transformers, they might stop you from, say, moving a vehicle crossing. You need to check the title for easements or covenants that may restrict you building in some way. So yeah, there's a whole lot of stuff that we look for. There are also some perks, and I know especially within the Auckland Unitary Plan, some sites have little perks. Say if you're next to a house that has a driveway servicing a rear site, that your height to boundary controls can actually go from the far side of the driveway, not your boundary. Or if you're next to a park, for example, your outlook space can be looking out over the park. It doesn't have to be contained within the site. So yeah, there's a few things there that we look for, and so these will definitely feed into what I would call the development potential.
Yeah, absolutely. And obviously Relab, you can see many, if not all of those things on Relab with the floodplains and zoning and driveway widths and all of that sort of stuff as well. We've got a lot of questions coming in, but we will get to those a little bit later because we are doing quite an in-depth dive here, and we do have quite a few things to get through. So let's just track on. So what are some of the effective strategies or approaches to consider when planning the development of a property? How can people determine the best course of action based on factors such as location, target market, and financial considerations? Either or both of you?
Sure. I mean, a couple of things. Obviously, we've talked about setting up the objectives for the project. That's a key one. Another one that I often talk to people about is learning to walk before you can run. Not jumping straight into a large multi-unit project if it's something that you've never done before. And in fact, we've found on multiple occasions that often a bigger project doesn't necessarily equate to a better financial return. For example, we did a project recently that we were in and out within 6 months, subdivided, renovated 2 houses. We made more profit on that than we did on a multi-unit project that took us 2 years. So again, it comes back to objectives, setting up that strategy, and learning the process at a manageable scale. Another thing is line up your ducks before pulling trigger on the build. It's getting through those first couple of stages before you start building. You want to make sure everything's in line, because as soon as you start building, essentially you're committed for 12, 18 months. And that's where the bulk of your spending comes as well. So you want to make sure everything is lined up prior to that before you push go on the build. In terms of target market, for us, it's about getting to know local real estate agents. They're the ones talking to the buyers. They're the ones, finding out what the buyers are looking for. So get to know them. If you've got a project coming up, send floor plans through to them. Again, they're usually really helpful at saying, hey, you do need to have an ensuite and a walk-in robe here, or actually, no, we think you should have a double garage instead of a single garage. So definitely, that's something we've found really, really useful in terms of understanding the target market.
Brilliant.
Yeah. And I think up front, knowing the numbers, I mean, at the end of the day, the project feasibility will ultimately drive whether it's fundable or not. So, is there a profit at the end of the deal? I mean, there are developments out there where someone has, gotten through it, and ultimately there's no profit at the end. And I don't think anyone really wants to do something for free. So really understanding the numbers up front. And also, as Thomas was saying, you're going to be in this project for a long time. Some of these projects go on for sort of 18 months to 2 years. So understanding the funding costs associated with it. So I see a lot of developers or first-time sort of developers coming to us, and they haven't factored in the financing costs. And when you're breaking that down, that's a key cost of the project. So really being clear about all of the project costs up front and understanding what the end value or the kind of gross realization that you're going to achieve on the final product is really important.
Absolutely. Hey, you go, Thomas.
I'm going to say that's why I would always encourage starting your financial discussions as early as possible, because they can be there to not only just assess your situation in terms of how much capital or equity you've got to use, but actually are your numbers looking right? These guys usually would have seen, I don't know how many offers or proposals put in front of them, and so they should pretty quickly be able to understand if you've got, if for example, the return's looking too good to be true, it probably is, or if there's any sort of key, financial costs, such as financing costs, that have been left out of the equation.
Yeah, I also think putting in a buffer and contingency. When we're assessing a project, we always put in a buffer, and we're always looking at a contingency on the construction. The construction, obviously, portion of any project, there's always going to be a level of execution risk and escalation with construction. Adding a contingency into the project, because every finance provider, every lender is going to have to see that up front.
Yeah, absolutely. Hey, just some admin. Thomas, if you could slow down your speaking. I know you've got a lot to say. So, there's just a little comment there about trying to catch all the good bits of advice. We all do it as Kiwis. We all talk super fast. I know I do. Hey, let's talk about red flags.
Sure. I'm sorry, I've got some direct sun coming in here,
fine.
Which is not.
It's better to see you. Let's talk about red flags and pitfalls.
Yeah.
Anything people should be aware of in the evaluation and planning stages?
Obviously, there's quite a few. When it comes down to early sort of design work, obviously things like underground services that we talked on before, making sure that they're located inside your boundaries. Even if they are located inside your boundaries, for example, with stormwater, the council don't like you to pump stormwater. So if you've got a sloping site and your stormwater line is actually located on the top part of the site, you're going to have trouble, and you want to build on the lower part, you're going to actually have trouble connecting to that stormwater line if it's not deep enough. So then, for example, you might be looking at a site and saying, hey, great, it's got stormwater within the boundary, but actually we can't use it for part of the development. We need to look at neighbouring properties. Where possible, we always try to avoid when we're needing a neighbour's approval for a development, because you just don't know, how they're going to, what their reaction is going to be to that. Sometimes and this is where, again, it's good to call the council and ask them as many questions as possible, because there's a lot of information that they have on file that you can't necessarily get online. And one example is capacity constraints for wastewater. I know there's a couple of suburbs in Auckland, Papatoetoe was one, for example, where the wastewater infrastructure has capacity issues. and depending on the scale of the project you're trying to do, you might run into issues there where actually you can't do as many units on the site as possible. They also know things like if you're on a sloping site, if there's been any slip histories on the site, or contaminated soil is another one that pops up every now and then. So again, talk to your local council. Tidal restrictions, are there any? I've had another project where there was a height restriction, which essentially didn't allow the project to build 2 stories. So to enable for them to do that, they actually had to dig down into the site. It was a blanket covenant that was put across a large scale subdivision about 40 years ago. And so to be able to actually even build 2 stories, they actually had to dig down into the site. So again, it's as simple as ordering a title. And if you don't quite understand it, send it to your lawyer and get them to look over any easements and covenants that are sitting on that title. Oversaturated local market is another one that we talked about before. Early on, if you're doing your feasibility, you're working out, okay, I want to do a build and sell project, and you might do everything right. You might have the best plans. Everything's looking good in terms of finance. But if you've just got a product that's in a market that's oversaturated, that just might not sell, and then you're sitting there waiting, probably incurring finance costs, which is not ideal. Another key one we see is, we need to remind people of, if you're doing a build to sell project, design with your end buyer in mind. You don't want to be designing often with yourself in mind, because you're not going to be the one living there, you're not going to be the one buying it. And this ties back into always talking to real estate agents. Who's your buyer? Try and put a demographic together. What's their age? What are they looking for in a design? So you can design around that. And another one we've seen is don't undersell everything as a pre-sale if you don't need to. Depending on your lender, and again, Dan can probably talk about this. Some projects will need pre-sales. Some projects will need 50%. Some will need 80%. Pretty much always you're going to get more money from selling a finished product. So if you don't need to sell everything as a pre-sale, then just sell the minimum that you need to do to cover your costs, or get your lending over the line, get them built, have them staged, and then sell them later on. And you should make more money from that.
Absolutely. Hey, in terms of financing, what are the typical costs associated with a property development project? How can I estimate the amount of money I'm going to need? And what are some financing options available?
Sure.
A few things to cover off there. Do you want to have the first go at it, Thomas?
I have a little chip at it, and you can finish off. For me, when we're doing feasibilities, early on, it is about educated guessing. Obviously we've seen projects from start to finish. We've got costs from real world projects that we can dive back into and see where those costs came in at. But what the feasibility is really good at is establishing, is this a $1 million project or is this a $5 million project? And then you can sort of adjust based on where you see it's coming in at. And in terms of how we break down the costs, usually we call them breaking down to what's called soft costs and hard costs. So soft costs are essentially anything that's done in the background. This is design costs, council fees, consultant costs, everything that's needed to get the project moving but isn't actually required to do physical works on site. And then you have your hard costs, which is essentially all the physical works that are done on site. Generally, your soft costs are around sort of maybe 20 to 30% of the project, and your hard costs make up the bulk of it. So that's why we're saying before, be ready before you commit into your building part of the project, because that's when, in terms of your finance, that's when it's going to take up a lot of it. And in terms of getting your finance, and again, Dan can probably give some more information here, but often lenders like the owner to be able to fund the soft costs themselves. So that means essentially going from feasibility through to being build ready, building consent, and then they'll look to jump in with the construction finance to do the actual build.
Cool. Yeah, I mean, I think in terms of financing, there's a lot to consider. I think, and if we sort of talk about what's happening in the market at the moment, there is actually quite a lot of funding available for projects. but a lot of the projects aren't stacking up in terms of their feasibility. So there's definitely money to lend, but it's been a tougher market because valuations have come off over the last 12 to 18 months. And where someone has bought a site in the last 2 or 3 years, the end values that they're aiming for just aren't stacking up in terms of making the project work from a finance perspective. So we've seen, obviously, after COVID, we had a massive boom, and there was a lot of development activity around New Zealand, and pre-sales were quite easy to get, and so that was allowing people to put a project together, start marketing it to buyers, getting properties under contract, and then that was unlocking the finance.
Yeah.
These days, pre-sales are literally impossible to come by. And that's where developers are requiring to put a lot more equity into the project upfront.
Yeah, absolutely. Which leads me nicely into asking what's the prevailing appetite of lenders to finance residential property development, and are there any specific trends or factors that developers should be aware of when seeking finance?
Yeah, just that the key point, I think, is around the lack of pre-sales that people are achieving at the moment. That buyers are not feeling confident to take on sign a sale and purchase agreement for a product that they can't actually physically see. So that's really slowed the market down significantly. We are still seeing some pre-sales in the investment property space, so where the underlying product is stacking up for a residential investment purpose. The pre-sales are a little bit easier to come by, but in terms of the owner-occupied market, pre-sales are very, very difficult. And in parts of Auckland, particularly in South Auckland and West Auckland, there is still a lot of kind of terraced houses, townhouses on the market. And I guess buyers have a little bit more choice. So we aren't seeing a lot of new projects coming to market with any real hope of getting pre-sales.
Gotcha. When you're applying for a development loan, what are the essential elements that lenders look for? And what are some key factors that can enhance the chances of loan approval and secure favourable terms? That's a big question for you, Dan.
Yeah, so we want to see a feasibility up front. So we want to see that the developer understands what they're doing and that they've actually gone through a process. They've done their due diligence. They've got their high level numbers across all of the key areas. If they're a new developer, we want to understand how are they mitigating that potential risk of someone not having the experience. Some of the lenders that operate in the market don't work with first-time developers. At Squirrel and on the Squirrel Money Lending business, we do work with first-time developers, but we want to see how is the developer mitigating that? Are they working with other professionals that are helping them along the way? And people like Thomas from I Am Developer and other consultants in the market can be quite helpful. So if we can see that someone's mitigating that potential risk by working with a good professional consultant, that's very helpful. Really understanding the end value, and ultimately we're going to need to see evidence of that. So having once you get into a project and you've got a scheme, you've got a resource consent, you've got something that a registered that you can get a as complete registered valuation on, and that gives us the confidence, obviously, that that there's going to be a project that's going to deliver a profit to the developer and something that isn't going to be too risky for the lender.
Yeah, absolutely. Hey, and finally, Dan, what's the main differences between traditional banks and non-bank lenders, and what's the advantages and disadvantages of each, and how can you decide what's the best for you?
Well, banks are much less flexible with lending overall, so I guess one of the biggest challenges that a developer has with bank lending is that they want to see that the developer can service the debt through the project, whereas non-bank lenders are more open to financing the development, including the funding costs, so the finance fees and the interest on the project. And for a lot of people, servicing the development debt through the project for a period of, say, 12 to 18 months isn't actually going to work for them. They may not have enough income from other sources to demonstrate that they can do that. So that's where non-bank lenders are really, really helpful in terms of making deals work without demonstrating that you can service the loan. Obviously, the project still needs to stack up. And so we will be capitalising the underlying finance costs into the lending limit, and that has an impact on the overall loan to value ratio, which determines how much money we can lend out. But it means that you're not servicing that debt through the life of the project life cycle. So that's probably the biggest difference. Another big difference is banks will generally require a QS involved in a project. So they'll want to see some kind of quantity surveyor providing an assessment of the costs and providing a layer of governance around the project and the drawdowns through the construction schedule. Now, QSs tend to be quite expensive, so that if you're doing a smaller development, a QS could be costing anywhere from, say, $20,000 to $30,000. If you're working with a non-bank lender who's a specialist in that particular market, they often won't always require a QS. Often they'll have their own team of kind of experts and consultants that they work with to understand the project and the risks associated with it. And yeah, ultimately banks, the kind of loan to value ratio that the leverage ratio that a bank is willing to go to on a development project is going to be a lot less than what a non-bank lender is prepared to go to. So we tend to see most banks are sort of maxing out at about a 50% LVR, and non-bank providers are going up to, depending if there's a pre-sale or some kind of debt cover, sometimes we're going up to kind of 70%.
Gotcha. Hey, and lastly, Dan, what are some of the key metrics and lending ratios that lenders consider? And can you provide insights into how these metrics and ratios impact eligibility and overall feasibility of a project? And I think you've got some slides or something to share with us there as well.
I've got a development little workbook, just a bit of a template. If you want to bring that up, I can run through just an example of the
Is that
things
the one?
So go to the first one. That's the second one. So this is just a little development workbook showing the kind of key attributes that we'd look at. And so at the top there, we've just got an end value or gross realization. That's how much you're actually expected to achieve from an end sale or a valuation. Then you've got your development costs, obviously your land acquisition, construction costs. I haven't put details in every cell there, but to give you a flavour, that's what we're wanting to see when we're looking at a project initially, just to do a high-level feasibility. As you work down, obviously the project funding required is going to be really, really important, and then that gives us the valuations, the calculations that we determine the financing costs on. So with most projects in the non-bank space, there's going to be a broker fee, potentially an upfront finance fee, which is charged by the lender. If it's a progressive drawdown, you're going to see a line fee being charged on the limit as well, and then obviously the interest rate that is being applied to the loan. And interest rates at the moment are anywhere from kind of 8% through to about 15%, depending on the nature of the project and the lender.
Wow. Did you want to go to the next one?
Yeah, I was going to just talk to the LVR. So in this particular workbook, you see that we've got a profit margin and the other ratios on the right there. So there's loan to cost, and then there's loan to value. So when any lender is looking at a project, we want to understand what is the profit margin that the developer is expected to get. We're not going to fund someone into a project where they're going to lose money. And in fact, some lenders have a minimum profit margin that they want to see in the project. And ultimately, that also has an impact on how much equity is the developer putting into the project up front. Most lenders want to see a level of skin in the game so that ultimately the developer is committed to the project and the project's going to be profitable.
We'll just answer that question there from Yuan while we're on that topic.
So the QS cost will completely depend on the project. There are different levels of governance applied to a development. Sometimes a QS might just provide an upfront cost analysis. Other times they might be involved in the entire project and actually be required to do supervision and sign off on every drawdown. So it depends on the scale and complexity and size of the project, and the fees can range anywhere from, I guess, for a basic kind of high level QS, you might be a few $1,000s up to tens, if not hundreds of thousands of dollars for a big project.
Understood.
Just a quick note on profit margin, because that's often one of the big key things about a project that people ask about. And for us, when we're doing feasibilities, we're usually wanting to see at least a sort of 25 to 30% profit margin on the project, knowing that the further we get into the project, that profit margin is probably going to slip once we get more real costs thrown in the mix. But if it's stacking up to be anything less than that sort of 25 to 30% mark early on, either we need to just reassess some things, potentially change the strategy, or move on to the next project if it's not stacking up. You don't want to try and force it to work, essentially.
Yeah. If the LVR, so if you're looking at a project and you're thinking, how much is it going to cost? How much money am I going to need to borrow? If the LVR is already over 80% on the as complete valuation or the gross realization, then it's not going to be fundable. So there's no way that that's going to work. So you're going to have to try and find some more equity, or look at potentially a joint venture partner, or trying to find some other cash to contribute to the project. And I do come across a lot of first-time developers that are looking at projects, and straight away the LVR that they're looking at is simply not going to work. It's not the same as kind of residential investment property lending. We obviously need to see that the LVR for a project that doesn't have a pre-sale under 65%.
And just a question there, 25% net or gross?
We usually look net profit but pre-tax. So obviously we want to essentially work out what all of our costs are. Once everything's done and dusted at the end, what's our net profit? And then from that, obviously we'll pay tax, and people's tax liabilities might be different depending on their situation.
Absolutely. Finally, before we get to some of those other really good questions, we'll just go to our last question. What are some practical due diligence steps people can take right away to ensure the feasibility and success of their project, and are there any initial assessments, research, investigations they should undertake to minimise risks and maximise the project?
Sure. I mean, a few things from me. I think a few of these we've touched on earlier. There's going to be so many questions you're going to have at the start. So go out there and start asking questions. If you don't know it, find someone that does. And don't be too stubborn to start paying for good advice early on. It's about building that solid foundation. And as part of that, you slowly want to build, your dream team of people that are going to help you through that project. And that starts with, someone who's going to help you do the feasibility, a designer or an architect. There's going to be so many other consultants needed along the way, a planner, a civil engineer, surveyors, your finance team. Slowly you want to build that dream team of people that can help guide you along the way. And in terms of investigation work, I mean, we're pretty lucky these days with online and internet access. There's so many tools online. Relab obviously is a very good one to help start doing some digging in terms of understanding your site. understanding all the council controls and everything, talking to the council help desk. There's plenty that you can get underway with straight away.
Yeah. And I think also looking at available data from the valuation platforms like CoreLogic and Velocity. I know that I think Relab has CoreLogic data available as well in the platform. So looking at comparable sales in the region, and obviously real estate agents will help you with that. But also if you are approaching a project and you're looking at potentially using existing properties or securities as equity, getting updated IVALs or automated valuations on those. So a lot of people are kind of using valuations from 2 years ago. Maybe it might be the CV or the purchase price. The reality is we look at the updated AVMs that are available from Velocity and from CoreLogic. So really helpful if you're looking at how much usable equity do I have in my portfolio to contribute to a potential project, doing an updated valuation across your portfolio before you start running the numbers and looking at buying something new or diving into a new project.
We have AVMs from Ryan's and from QV, so you can just find those directly on Relab as well. Hey, cool. Let's just jump in and start answering a couple of these questions before we sign off. We've got sort of 4 or 5 minutes to go, so we'll start with this one. Can you start the subdivision, civil works, services and building at the same time, or is it better to get 2, 2, 3 first before starting to build?
Yes, absolutely. You can start them at the same time. The usual process, if you are doing a subdivision as part of your development, is that once you've got your resource consent approved, you essentially branch out into 2 paths that run in parallel. One will be the civil works for the subdivision, and one will be the building works, which will be your building consent and then construction. Especially when you're looking at underground services, you're going to have public works that are required as part of your EPA, but you're going to have private works that are required as part of your building consent. And it can be a bit frustrating that you can't actually do them, you can't get them approved through the same process channels. But definitely I would say get underway with both at the same time. It's probably going to be your civil works that take the longest amount of time, not necessarily just for the build component, but for the assessing and processing at the end of it, where in Auckland, for example, we're dealing with water care, the council, Vector, all the chorus, all those people. There's a lot of processing that needs to happen, and at the same time, you should be keeping your build going. Gotcha.
Here's a question for you, Thomas, and I know the answer to this one. Do you have a copy of the path, the 3 stages? Yes, indeed, and that's going to be on the email that we'll be sending out to you if you have ticked GDPR, yes, on your registration. Another question here from Nathan. Can you expand on due diligence? What that's a hard one. Due diligence should someone undertake, and professionals to contact?
I mean, essentially, the list of professionals you've put there are going to be key. I guess you need to slowly start bringing more and more consultants or professionals into the equation. I know, for example, when we work with projects, we bring our planner in as early as possible, even at the design stage. From some other practices I used to work at, sometimes it would be a case of, we do some great design work, and then we say, we need a resource consent now, we'll go get a planner, and the planner comes in and says, hold up, have you thought about this, or you haven't done this? So an example there is that bring your planner in as early as possible. And I find that most consultants, if you call them up, are more than happy for 5 or 10 minutes to just chat through some aspects of your project, even if haven't formally engaged them. Most people are pretty helpful. I guess at some point though, you do need to start paying for advice. So don't think that you can keep calling people and getting free advice, but most people have that initial conversation and give you some free advice.
Hey, so can the outlook requirement extend over a neighbouring access lot or row in the same way as the HIRTB?
If it's a rare site, that's more of a planning question. I need to double check that. If it's the driveway servicing a rare site, either it's a yes you can, or it's the council will look more favourably on it. But so the outlook they're referring to is that the main one is a 6 metre by 4 metre rectangle that has to come from the largest area of glazing your main living space. And usually it has to be contained within your boundary. So it can, on a multi-unit project, it can be quite difficult to design around keeping all of those large rectangles within your boundary. So yeah, I need to double check that, but I think with rear driveways they can. Definitely with parks, if the park's over 2,500 square metres, then your outlook can be out over the parks. So having sites next to parks, there's definitely some
okay, cool. There. And this one's for Dan. Any tips for reducing finance costs for a single lot subdivision, getting bank loan once title received?
So yeah, I mean, depends on how you're funding that up front. I guess if you're using an existing security, you might have an existing property that you could get a revolving credit line against with a bank, and if you're planning to build on a site, whether or not you're kind of getting access to builder terms so that you're not financing it up front. But yeah, I mean, I think a lot of people would try and sort of use existing securities or assets to get release some equity and use lower bank funding up front before they start tapping into higher cost construction.
Cool. Hey, so we're just out of time, but we're going to answer one more question. At what stage of the development is it possible to take it to the market? That's a good question.
Sure, the easy answer is and what most people usually do is once you have an approved resource consent, because essentially you've got the tick from the council that this project, the scale of it, scope of it is going to go ahead, and the other stages following it are more sort of building code box ticking sort of approvals. In saying that, there are situations where you might want to say take it to market pre-resource consent and just sort of look for expressions of interest. Because if you're just sort of testing an idea, is this proposal going to sell? Are there going to be people interested in it? Let's put it out on TradeView, let's put it out on the market, see if people are interested. If they are, stay in touch with them, go get your resource consent quickly, and then get them locked into a sales and purchase agreement. But generally, most people take them to market once resource consent has been approved.
And I will squeeze in this one more question because Nathan's asked it again. What's the experience with success and ROI for cheap versus high spec?
I think that depends on where you are building.
Yeah.
Because if you're going to build cheap in a more upmarket suburb, you might not have much luck. If you're going to build high spec in a lower suburb, then you might overcapitalize and not make any money off it. So, yeah, personally, the way we look at projects, the way I design is every project needs to, it's going to be there for 50 years. You want to be able to drive past it and be proud of it. You want to show people it. You want to show it online. So for us, going down the cheap and cheerful route is not really within our sort of core values of how we design projects. In saying that, you can still do cost-effective projects that don't cost a huge amount that still look really good. And I think if you can strike a really good balance in maybe those areas that aren't more affluent suburbs, you can still do a nice product that's cost effective, then you're probably going to stand out above a lot of people. Because there is, unfortunately, some areas where there's some pretty poorly designed houses getting built. So it wouldn't take much to sort of stand out.
Absolutely. So we're actually going to wrap up now because we're way over time, even though the questions do keep rolling in. We could literally go on forever. Yes, Nathan, it was an awesome session, and we'll certainly get these guys back again. So thank you very much to my guest Dan from Squirrel and Thomas from I Am Developer, you will get a replay of this in your inbox shortly, so you can rewatch and forward it on to your colleagues and so forth. If you do have any more questions, feel free to forward them through to me, and we'll see what we can do. Thanks again for the golden nuggets everywhere. Yes, indeed. Plenty of golden nuggets. So thanks, team, for joining me, and everybody have a lovely weekend.
Thanks very much, Lou.
Thanks, Lou. See you guys.
See ya.